Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, February 27th, and this is the weekly market update. So before we get started, just want to remind folks that are listening on our podcasting, we've made podcasts of these videos. We've put them out there via Anchor. They go out to Spotify and different, I think 7 or 8 different podcasting platforms that folks like to use. It's really helpful to us, guys, if you enjoy these videos, if you enjoy the podcasts, if you get value from it, if you could take the time to write a review, if you could take the time to, however they grade those on there, like with stars or whatever, if you can give us some kind of feedback, positive, of course, that would be great because it helps us move up with the rankings, introduce more people to this. What we're doing here, this alternative media. You're not going to see this kind of stuff on CNBC. I'm just going to get ready to show you an example of the nonsense that goes on in the mainstream media, the lies, the distortions, the BS, the bait click. I mean, I'm totally against this. So we're trying to put out good information here. Well, I shouldn't say we, I am. And I try to aggregate information from a lot of really smart people. And saying that this week, I put it in the show notes. I have a side site where I just curate and upload links to podcasts, videos, research papers, whatever I find that I am looking at for different things that go into investing or macro themes, whatever. And you may find that interesting because, believe me, I'm not an expert on macroeconomics or microeconomics. I'm not a financial forecaster. I'm a guy trying to make a buck in these markets. I do have some wisdom. I do have some experience, hard gained. I have a lot of slashing wounds on me from the battles I've been in, but I'm trying to help you become more successful at your investing and try to get you to think right about how these things work. So there's a lot of smart people. They give away a lot of their information, and I try to aggregate that. So this was a really great week for that. So take a look at that. Also, please, we're really grateful for the support we get here every week. Channel continues to grow. This has really grown well beyond anything I ever thought. I mean, who would want to listen to somebody, who would want to listen? That's what I originally thought. But I started doing this. I stuck with it, and we've built a really great audience. I get a lot of great emails, DMs, feedback. Be surprised at different people that write to me, that people they know or things that they're involved in, and it helps me get even more insight. You'd be surprised who actually listens to this. So really want to thank the listeners. It's listener supported, and we really appreciate you guys. All right, let's get into this week's market update. So when I first saw this is the cover of the current issue of Bloomberg Businessweek. And when I first saw it, I saw it on Twitter. Somebody put it up there. Actually, I think it was Jared Dillon. I think he writes the Daily Dirt Nap. And he actually, in his tweet, and he had this in it, he actually had his tweet actually said, "Get me out of this effing market." Of course, he didn't say effing. He said, F-U-C-K, this market. So, and I thought this has got to be fake. I mean, Bloomberg Businessweek. I mean, I had a subscription to Businessweek, maybe starting when I was 14 or 15 years old. My parents were very gracious in any kind of reading I wanted to do. They would allow me to buy books. They bought them for me, magazine subscriptions. I mean, I was reading Barron's and Businessweek and Forbes and these things and going to the library all the time. And this was like, to me, was like a pretty decent publication back in the day. I mean, I haven't read it in years, especially since Bloomberg took it over. I just don't have any interest in mainstream financial press. I know they're always way behind the curve. So I thought this was an actual parody or joke. And this is actually dated March 1st, 2021. This is the current issue. And it has a picture of an Air Jordan on there. And has a little side thing here. It says, sneakerheads have created a gravity-defying, pandemic-proof commodity of their own. And then it has in big black on the bottom. It says, "This is not a shoe. It's an asset class." I mean, they don't really ring bells. They say they don't ring bells at the top. I mean, guys, really? I know a guy that does this on the side. He does shoe things. I never really got into it. He told me about it. He makes money. I don't know. It seemed like more of a hustle or something like that. But this is not an asset class. These are shoes. They're like every other collectibles. I talked about this, in the thing that I'm interested in as far as collectibles, which are I collect rookie cards, graded, high grade rookie cards of baseball Hall of Famers. That's what I'm trying to collect. A rookie card for each Hall of Famer in as highest condition as I can afford. And the prices for these things have blown out over the last year or so. I mean, they have went up tremendously to the point where I don't buy anything right now because prices are just too nuts. Because you have all these people, you got Gary Vanderchuck in there. He's investing in baseball cards, baseball cards and tennis shoes and, 67 Barracudas and, all this. These are not investments. Okay. They're collectibles. They're things that you buy because you enjoy collecting them. They remind you of maybe your youth. They bring back memories of when you followed players. For myself, like in baseball, and in times when it was a different time, when when you were a kid. That it's for reminiscing, that kind of thing. But do I consider baseball cards an asset class? No. I mean, collectibles can go up in value. They do, uh, but they also go down in value. And when you see things like this, and I see what's going on in all these collectible classes with all of this huge rises in prices, people think that, they're some kind of big genius now. So you're walking down the street and you find $1,000 bill sitting in the gutter and you pick it up. Now you're an investor. I mean, this is what basically it's analogous to. Just because you find $100 bill on the street doesn't mean you're a great investor. You got lucky. And this tells me a lot. For what I thought was a mainstream, serious, Bloomberg charges $25,000 a year, I think, for that terminal of theirs. And Businessweek used to have really great articles. And just their annual review with all the companies and all the financial stuff, I used to pour through that. I mean, I thought it was a serious publication. This is ridiculous. This is clown world kind of stuff. And this is ringing the bell at the top. You have this debt-fueled, Fed-induced liquidity bubble and the everything bubble. We've talked about it. And if this isn't a indication of that, I don't know what else is. I mean, will an asteroid please come in and hit this planet? I mean, this is too much. So do I think things are going to get even crazier? Quite possibly, but this has to be, there's no discussion about, what's happening in reality in the financial markets. We're talking about sneakers as an asset class. It's ridiculous. So I don't know, maybe I'm an old fuddy-duddy, but I'm just telling you, I mean, this is not, you're seeing this in everything. All these collectible classes, these guys that are hustling around, everybody's into it now. There's like in baseball cards, there's so many channels now where people have baseball investment channels, baseball card investment channels. They're not investments. They don't produce an income. They're collectibles because you enjoy collecting them and you enjoy the chasing down these different hard to get cards and the community of people and going to card shows and this kind of stuff. That's, enjoyable. It's a pastime. And, maybe if you were a collector for 30 or 40 years, then after you tip over, somebody inherits it and they say, oh, wow, this is pretty good collection. You can sell it. They can sell it or whatever, but it's not an investment class. And I'm seeing, like I said, these prices are going nuts because everything's going nuts in price because of the bubble that we're in, all this liquidity that's being created by these central banks. It's all going to end badly. So I wanted to talk about uranium. This is something that is, undervalued still, even after the moves we've seen. And, the news just keeps trickling out, right? I don't really talk too much about uranium. I've said why I haven't in the past, just because there's not much to say. I mean, the supply is going down, the demand's going up, and price will eventually have to, go up to pretty a pretty decent amount to incentivize the new supply that will be required to supply all the new reactors and current reactors. But this is something we were waiting to see. So Yellowcake PLC, which is the kind of the UPC equivalent that's in Great Britain, announced that they are going to purchase 3.5 million pounds of uranium from Kazatomprom after raising $140 million in a recent offering. So basically, if you're not familiar with what like Yellowcake does and UPC, they basically just buy uranium on the market and hold it. Okay, so it gives you they're kind of like closed-end funds, if you will. So what happens is the shares trade in the open market, and sometimes they trade below net asset value, which has been the case for a while, or in some cases, the share price will trade above net asset value. So you've seen that like in the Grayscale Bitcoin fund, that was a situation there where it traded way above its net asset value. Same thing's happening with Yellowcake. So I think I looked it up. The current net asset value is like 2.34 British pounds, and the share price is like 3.2 or 3.3 British pounds. So the share price is selling at a premium to the net asset value. So it makes sense for them to sell shares and buy uranium. They're basically, they're not undercutting their net asset value. So that's what they've done. As a matter of fact, the original proposed amount was for 110 million, but the uptake on the offering was so high, they raised it to 140 million. So that tells you there's demand out there. There's more demand than they thought. And so if you go back, I'm not going to get into it here, but if you go look at the documents and look at the Yellowcake website, you should know, if you've been following uranium, they have a agreement with Kazatomprom that allows them to buy a certain amount of uranium every year if they choose to. I think for the next 8 or 9 years, something like that. So they're exercising that option this year. So what that tells everybody is this is just another, this isn't just one event that's going to be the catalyst, but this is one of many events that we just keep seeing more and more of these news items that are positive for the price of uranium. The other thing that came out this week is, France's Nuclear Safety Authority agreed this last Thursday to extend the operational lifetime of the country's 32 oldest nuclear reactors by a decade to as much as 50 years. Well, that's great because that's more demand that wasn't anticipated, right? Because we're seeing that all over the world now. We're seeing that the engineering and manufacturing processes for these reactors was so good that they have the ability to continue to generate electricity well beyond what people originally thought when they designed them. And we're seeing that not just in France, but all over the world. And with the current zeitgeist, ESG zeitgeist, nuclear is becoming more and more into the discussion of carbon-free clean energy. Even the Biden administration is speaking positively about it. So what I found interesting when you read the article, and I'll put a link to both of these items, it was funny, the Germans were complaining that France was doing this because, Germany, as part of their energy transition, and because of what happened in Fukushima, has committed to shutting all of the nuclear reactors by 2022, I believe. And so, if I can't have something and you have it, I'm just going to try to break it. So it's one of those deals. Pretty short-sighted of the Germans to shut their reactors, but nevertheless, they'll just keep importing more nuclear-generated electricity from France. UPC is actually also, which is the Uranium Participation Corp, is actually trading at a premium to its net asset value. So I would expect them to be making an announcement as an offering and going into the market to buy more uranium. Now, what we've been hearing, especially if you listen to the Smith Weekly presentation with Michael Alkin and guys from Sachem Cove, the hedge fund that invests in uranium, I think it was on last week. I put a link to it in the show notes. I mean, we know that there's not the spot market's shriveling up. There's not that much material out there. And people are just like, well, why isn't the spot price going up? Why is it? So be patient. This is happening. I mean, there's basically no mining, I don't think, happening in North America right now of uranium mining that I can think of. Somebody can correct me, but most of the uranium mines are closed now or on care and maintenance. And yet the demand is there. So, we're getting to that tipping point. I think this is going to be the year when you actually start seeing the spot price move higher. You'll start seeing announcements that utilities are signing term agreements. I think this is going to be the year. And regardless, the stocks are already sniffing it out. The other question I have here, the last bullet point I had was, how many hedge funds can see what is happening with uranium supply and are going to enter the market and buy physical? They did it last cycle. So I found an article about a hedge fund that did this. I'm sure it wasn't the only one, where they had established their positions in various uranium mining companies, which there weren't that many at the beginning of the last cycle. And then they were in buying physical uranium. So these hedge funds exist to make money. And if they think that they can make money and they smell a scenario where there's a supply deficit and they can take a position in stocks and then start buying, because you can buy physical uranium. I think you have to buy it in 100,000-pound lots, but you can store it. You can buy it and store it. You can do that. And I mean, if you're a big player, you could buy yourself 100,000 pounds and store it. Cost you about $3 million. And why not, right? And if you're a big player, say you had $1 billion hedge fund and you wanted to put 100 million in, I mean, you could buy a bunch of the stocks and then put 50 or 60 million dollars scale into over time. And if more than one or two people start doing this, you could really light a fire under the price. Because this is what happened last time. It then becomes a speculative frenzy, a feedback loop. It starts feeding on itself. The price moves higher, attracts more speculators, rinse and repeat. So this is what we can really see happen. And like I've told the story before, I can remember during the last bull market when they would come out with the weekly spot or the weekly price updates for uranium, it would just like go up every week. Oh, it was up $2, and next week it was up $1.50. Then the next week it was up 75 cents, and it was up $3. I mean, it's just like, does this ever go down? And of course, the share prices exploded higher based on this. So the other thing I want to point out is with a lot of commodity markets and resource markets, when they're in extended bear markets, they usually, they can lose anywhere from 80 to 90% of their value, which is typical. But when they do recover, it's not unusual for them to overshoot on the upside and exceed the previous highs from the previous cycle. So a lot of people don't want to say that, but there's a very good possibility that could happen. Why could it not? That's not atypical. That's or that's not unheard of to happen. So something else to think about. So I was talking about all the good people that I follow and curate their work. There's a guy that I follow. I get his emails. I think he works for CMG Wealth Managers or something. He puts out this weekly email. They also have it on their site. His name's Steve Blumenthal. Man, he really does a super job on really disseminating. He curates a lot of great macro type information, a lot of financial historical information. And past is always prologue, right? I mean, things don't repeat exactly, but they seem to repeat. And so his email this week was so good, I just wanted to touch on a couple of things he said. So he was talking about this big move we've had in the 10-year Treasury. And he said, rates are spiking. In the past 7 months, they've gone from 0.62 to 1.52%. This is the 10-year. He goes on to say the government is spending 8.1 trillion per year. They say they are spending 6.6 trillion, but it comes to 8.1 trillion when you add in the off-balance sheet items. That's 40% of U.S. gross domestic product. Worse, 4.6 trillion of that 8.1 trillion in spending is borrowed and thus added to the debt pile. And massive stimulus is coming in the form of Biden's $1.9 trillion COVID-19 package and future infrastructure spend. That debt will never be paid back. So the House last night, I believe, passed the $1.9 trillion COVID recovery package. Recall that the infrastructure package is a separate package. So that's coming too. And that's initially being slated at starting point for the negotiation is $3 trillion. I'm not going to get into the merits of this. Basically, if you listen to various pundits or people have analyzed it, only 9% of this $1.9 trillion is actually slated for COVID recovery, most of it is sops to different constituencies on both the Republican and Democratic sides. That's what these things always are. It's massive bailout for a lot of the mismanaged Democratic cities and states, but it's not even worth talking about. There's nothing you can do about it. What matters is this is what's happening and what are the repercussions. Uh, this debt will not be paid back. So the next point is this is not bullish for the dollar. No, it's not. To borrow this kind of money and spend this kind of money in 1 year, 40% of GDP is not bullish for the dollar. Believe me, longer term. A declining dollar is inflationary. Well, that makes perfect sense, right? Because the dollar is the reserve currency in most of the commodities in the world, and a lot of the services are priced in dollars. So if the value of the dollar goes down, it takes more dollars to buy the same amount of goods. That's inflationary. So the cost of goods to U.S. consumers will rise. Supply disruptions, chips to steel are inflationary. Is this transitory? In the short term, maybe, maybe not. In the not too distant future, inflation. So what I put in here as a blurb is what we've seen this last week is a lot of things just got killed. I mean, you saw the tech stocks get killed. A lot of the darlings, things that really proliferated, that really did well in a very, very low interest rate environment are not going to do well as interest rates move higher. Okay. And we can look back in history. This is not the first time that rates have risen or we've had inflation. So what does good? What does well during that? Typically, the stock market itself does not do well, but there are pockets that do well, i.e., commodity and resource stocks, right? Because commodities tend to do well in these environments of higher inflation. What else? Emerging markets will do well in a declining dollar environment because a lot of them are commodity producers. Okay, so that's what we've been talking about. We've been talking about these sectors in these videos and in the newsletter, and they've responded very well. During this worldwide COVID thing, we had the opportunity to really buy some really great bargains in some emerging markets. I've talked about the country of Georgia. I've talked a lot about how interested I've become in Africa. And, there's tremendous amount of opportunity around the world. The ability to access these opportunities is difficult. That's why the time to get into these is now. Spend some extra time and effort to do it. It's not impossible, but it takes work. You can't just get on your Robinhood account or your TD Ameritrade account and buy an ETF. By the time you can do that, the play will be over. Let me say that again. So, in another way, your advantage in these markets over everyone else is that there's an dearth of information. Information is hard to get, but it's not impossible. You have to create some relationships. You have to do some investigation. You have to figure out what's going on. And then setting up accounts or accessing these markets is not impossible. There's different vehicles. Some of them are exchange traded. They're just not well known. And then the ability to have a relationship or get your butt on a plane and actually go somewhere and set up an account. So there is ways to do this, but that's where the real returns are going to be in this decade, I believe. So what you can expect, though, is a lot of volatility because with these rates shooting up like they are, I mean, we're experiencing a tremendous amount of volatility now. And, even a lot of the stocks that are in the portfolio, they're going all over the place. But, I think longer than a week or a month, you got to think out a year, 2, 3, 5 years to what you think is going to happen. So it goes on in this article that Steve Blumenthal put up. The Fed is basically trapped here, right? So Jerome Powell has made it clear during his congressional testimony that the central bank had no plans to step in and put a lid on rising rates, right? Remember, he said that they weren't, that we'll have to see if that's really going to work because rising rates are not going to be good for the economy and can cause a lot of disruption and can cause the federal government a lot of money because based on the amount of money it has to borrow. I mean, what should be the real rate of interest right now? I mean, it's 1.62 on the 10-year, but you have people like Jeffrey Gunlosh saying it should be closer to 3%. I don't think that the U.S. economy can handle a 3% 10-year Treasury rate. The housing market would start to fall apart. I mean, so it's going to be very interesting. These guys have got themselves in a trap, right? So all of the previous machinations that the Fed has done through all the previous crises, You know, it's like steering a car on a frozen road. What you should do once you start entering black ice and losing control is take your foot off the accelerator. Okay. Instead, what the Fed has done is push the accelerator to the floor and is now oversteering more and more and more until they're going to fly off the road and have an accident. And they can't stop doing what they are doing. If they do, we will have a deflationary collapse, which would result in basically a revolution. It's not going to be allowed to happen. Will we have volatility and scares? Yeah, we had that at the end of 2018 when they said they were going to allow rates to start going up. They were going to start reducing the bond purchases. And you remember what happened? The market dropped 20%. And the Powell reversal. Remember that? That's what will happen. That's what I'm talking about, volatility. So they're now on this course now where they're stuck. What are they going to do? If they let things run hot and inflation ends up at the end of the year 4 or 5, or God forbid even next year 7 or 8%, what are they going to do? What will the 10-year be then? The economy would collapse. Rates would rise in anticipation. That's what they're doing. Rates are rising in anticipation of the inflation that's coming. Markets look ahead. So, despite the clear move in markets, Powell reiterated that he does not expect to see materially high inflation in the near term, and that he does not expect to take any policy action should inflation metrics move above 2% this year, because that is likely to be transitory. So, these guys are always out to lunch. They really don't know what they're doing. And, they're trapped. What are they going to do? I mean, they have to go along to get along and hope it all works out and hope something miraculous happens and bails them out. I mean, that's what it seems like to me. And so they have one of the other Fed presidents gave a speech, and this is what they said. This guy's name was Clarita. I don't know all their names. I forget them all, but this is what he said. We, to a person, he's talking about people at the Fed, are going to be patient. We are going to be very careful, and we are going to be very, very transparent of our intentions well in advance of any decision we make in the future. Meanwhile, I put this in here. Meanwhile, commodities are ripping. I mean, look at what copper. Copper traded up to $4.50 a pound this week before we had the pullback and everything late in the week. I mean, oil is, Brent was pushing close to $70 a barrel. Brent oil was 68, I believe. It pulled back. I mean, everything's on fire. Agriculture commodities are on fire. I mean, up double digit. Lumber up over 100%. There's no inflation. I mean, what are these people talking about? So those prices are going to work themselves into the economy. They're going to start showing up in the statistics. And how far can the Fed let the 10-year go up? I mean, there's talk among people that are a lot more smarter than me that they're going to start having to think about doing yield curve control where they hold yields down. And we've talked about this before. I'm not going to get into it again, but they hold yields down by going in there and buying the treasuries to hold the rates down. And then the inflation rate gets above the 10-year rate, then you have negative real rates. That's a way to deal with these huge debts that we have. So a lot of things are happening, and I just want to emphasize that it means that we're going to have a lot more volatility. But you need to use volatility as your friend. I mean, uranium stocks got nuked at the end of the week. Nothing's changed fundamentally. If you wanted to increase your positions, you should be watching these markets. If stuff drops, if you're not prepared in a resource market, okay, with resource stocks that we deal with, to see a 50% move up or down, I mean down in a company over the course of a year, you should not be in these markets, because that's what will happen. That's how volatile they can be. And nothing can fundamentally change with the company or industry. And yet these things can move all over the place. So use volatility, make it your friend, and if understand what you're buying. Write it down. I've said this before. And if things get cheap, then you should be buying them. If the thesis hasn't changed and things go on sale, buy. Okay, that's what I do, and it's worked out fairly well. I wanted to post this. This is from Basso Analytics. This is the basically offshore drilling rigs by month working in total. You see the numbers this last month. What's interesting, you can see we called this. We were recovering before COVID. The offshore industry was recovering. Day rates were starting to inch up, and then we had the oil crash because of COVID. And you see what happened to the amount of rigs that were drilling offshore. All the major rig operators are basically in bankruptcy or working their way through bankruptcy. But you'll note the thing bottomed. The industry, the the amount of rigs working bottomed around November, and now we're slowly working our way higher. You can see this is the utilization rate. It's still in the dumps. I'm not ready to say, hey, we're out of the woods, but going through bankruptcy, rationalizing the fleets, getting rid of a lot of the older rigs is going to be a positive. And with oil prices climbing, I believe that this is not like a one-off that's going to go away. This is going to be, in a couple of years, we're going to have a serious energy crisis in the world because we didn't do enough investing in new reserves because shale sucked all the energy and capital away from every other form of oil exploration, pretty much. So we thought shale was going to, be the cure-all. Remember the nutty projections that shale oil production in the U.S. was going to go to 20 to 25 million barrels a day. It never did. It peaked out at 13. It's down about 2 million barrels already. So we're seeing some more activity onshore, but you know, reiterating the fact that if you listen to a lot of the producers in their conference calls, they're still saying that they're not going to go rushing back in and drill. They're committed to returning capital to shareholders by debt paybacks, dividends, and share buybacks. So we'll see if that changes. Things change. People say one thing and they do something else. But I wanted to point this out because this is another thing that no one's paying attention to. I'm tracking all of the offshore companies. If you listen to Transocean, they just had their earnings report, I believe, last week. I read the transcript. It's not super bullish, but they even talk about that they're starting to see more activity. They're signed some new contracts at higher rates. That's indication that, we're sniffing a recovery here. So it's going to be a long time. It's going to take a while. These companies are going to come out of bankruptcy and they'll relist their shares and then we'll be taking a look at them again. But hopefully, a lot of the debt that was holding those companies back and the opportunity to get rid of a lot of uncompetitive rigs or older rigs, write them all down, send them off to the scrap yards, and then have a more lean, mean uh, industry that will then be have a supply deficit as the investment comes back into offshore oil, which we anticipate over the next 3 to 5 years. So I wanted to point this out too. So what I've done here is I have an account on stock charts. So I like to go in there and play around with different metrics. You can do that. And what I did here was I just compared the price of Tesla to ExxonMobil. Why did I do this? Well, you recall that Tesla was added to the S&P on December 21st of last year, and I did not agree with that. Most of the money, a lot of the money that's being invested by the average people in 401ks and IRAs just goes into passive investing into S&P 500 index funds. And so these people, those are market cap weighted indexes and funds. So when you have a very large market cap like Tesla, it it enjoys it it the funds are on autopilot. So the market cap of Tesla, every $100 that comes into the fund, they have to buy the highest market cap stocks. And what are those? Amazon, Google, Tesla, all these overvalued tech stocks. So what was removed from the index to make room for Tesla? Well, ExxonMobil, the largest oil company, private oil company, I think, in the world, or one of the largest, and it was removed. So what I did was I compared the price to each other back about 5 or 6 years, and what you can see is, Tesla was really outperforming ExxonMobil over, since about mid 2019, right? Had this tremendous run because it's a new economy, right? Tesla's going to take over the world. It's a technology company. Elon Musk is a genius. Blah blah blah. ExxonMobil is evil. It provides a product that kills people. Make it go away. Sue them. All this other crap. And you'll note that the since basically since Tesla was added to the index, ExxonMobil has outperformed it. So when this is going up, Tesla is outperforming ExxonMobil. When it's going down, Tesla is underperforming ExxonMobil. I just find that interesting. If you go back and look in history, this has happened before. One of the things you will note, especially if you read some of the things that I put up on the curation site that I put, this is not the first time this has happened. We many smart people, before this is all over, the bull market in value and commodities and resource stocks that I anticipate this decade, this number will be back down here again. Okay, and it's going to be shocking how the munchkins, the elves over at S&P are going to wiggle out. I mean, how they're going to try to have to kick Tesla out of the S&P, and then what are they going to do? I mean, this is going to be bad. And what's going to start happening now that energy is outperforming, specifically oil and gas, is outperforming technology and has been now recently. If you're running a fund, it's all about performance. No one cares about your ESG or how woke you are. If you are not making your numbers, you are going to be gone. You are going to be shining someone's shoes. And what these guys do is they chase the shiny object. That's what they do. And if you ain't making your numbers and if you ain't outperforming your benchmark, you are going to be gone for the most places. And they ain't going to care that you come in there and tell the investment committee that, well, well, we are diverse though, and we are woke, and Tesla, it's ESG. They're going to be like, hey, we're underperforming and we're losing assets. People are moving their money out of the fund, guy. That's reality. Okay. And I suggest that's probably what's going to happen. I do not think, you know, if you were looking at this as a stock to buy and you saw this, would you be looking at this chart? Would you be a buyer of this long term or a seller of this long term? Well, I'd be a seller. Look how overbought this is. Look at the extreme outperformance of Tesla as related to ExxonMobil. Now you can have I'm not going to get into the argument about this. You can have the facts are the facts. And this thing is way extended above these moving averages. And it's obviously rolled over on some of these other metrics, relative strength, MACD. These are technical indicators. Now, yeah, maybe it can turn around and maybe it'll make another run and go completely vertical. That's very possible. Okay. Especially with all the money printing that's going on. But I think we're starting to see the rotation that we were anticipating. We're seeing it all across the board, guys, in all these different resource markets. And these technology companies are not going to perform in a rising inflationary and a rising interest rate environment. They just do not do that. That's the historical narrative. Believe me, if your 3-month or 3-week career in speculating or investing in Robinhood and you're getting in now, you've had a bad couple weeks and you're going to have a bad couple years. You're going to get wiped out if you don't understand the history, if you don't understand the intermarket relationships between interest rates, the dollar, valuations. If you don't understand these things, then you're just gambling, and that's fine. You can do that, but that's why I made this channel. I did that when I didn't know what I was doing, and the worst thing that can happen to most of these guys is they have some initial success, and then they, like I said, they find $100 bill or $1,000 bill sitting on the street. They pick it up, and also they think they're a great investor and they did something. That's not what happened. You were lucky. So you can, the arrogance that I see out there, the, have fun staying poor comments and all this nonsense, denigration of people like Buffett and stuff like that. The guy is a billionaire. He's the greatest investor of all time. Or Munger, he just recently had he's a chairman of the board of another company. I forget the name of it, but they just had, it's a smaller company that does legal publications or reviews and stuff. But anyways, he was talking about some of these things, but everybody says these guys are washed up, right? They're fuddy-duddies, but they've been doing this for 70 years and they're multi-billionaires. But, because they're not on the current zeitgeist or following that which is fashionable today, but, the same things were being said about these guys during the dot-com bubble, same thing during the housing bubble. And, they're still there, and Surge the Trader and these dinks that are on Robinhood will be gone tomorrow. So just wanted to leave you with this. I suspect over time, we'll keep looking at this, but I suspect over time that Tesla is going to do worse against ExxonMobil over this decade. So that's my speculation. That's my view. All right, guys, that's it for this week. Again, appreciate the support, appreciate the listeners, and I hope you got something out of this. And we'll talk to you next week.